There's a lot of confusion about whether AI is a massive bubble or the next industrial revolution. We're seeing stocks rally 5% one day and crash the very next morning on a single headline. It's exhausting. And if you're feeling that pit in your stomach every time you open your brokerage app, I want you to know that's exactly what the market is designed to do to you. It is built to drain you emotionally until you make a mistake that benefits someone else. In this video, I'm going to help you stay calm, not by giving you some get-rich-quick hopium, but by showing you how the pros actually handle this chaos. We're going to talk about why most people are biologically wired to lose money. And more importantly, I'm going to share the exact framework I use to stop thinking like a gambler and start knowing like a Zenvestor. Human beings are wired for survival, not for 10% annual returns. Our brains evolved to recognize a sudden drop in safety as a threat. In the wild, if you saw a shadow move in the brush, you ran. You didn't wait for a fundamental analysis of the predator. When you see a red ticker symbol like Nvidia or Microsoft drop 4% in an hour, your brain's emotional center, the amygdala, triggers that same fight or flight response. Your heart rate increases, your vision narrows, and your brain screams for one thing: safety. This is the volatility tax. It is the price you pay for acting on your biology. Retail investors get sucked into this cycle, waking up every morning addicted to the ticker, watching numbers move up and down like a drug. They become day traders by accident because the volatility drains them until they panic. To beat the market, you have to realize that your psychology is just as important, if not more important, than your strategy. Let's be clear about one thing. What we do here is not gambling. We never invest in meme coins or hyped-up narratives that have no bottom. In the stock market, liquidity is both a blessing and a curse. It's a blessing because you can buy and sell easily, but it's a curse because it makes you feel like your investment is just a number on a screen. Think about real estate. If you buy a $500,000 property, it's not going to zero next week. You have the land, you have a physical asset with intrinsic value. Solid companies are the same. When you buy into a business that generates billions in revenue, has a massive moat, and owns the infrastructure of the future, you aren't buying a lottery ticket. You are buying a piece of a productive machine. These companies do not go to zero. They have assets, patents, and cash flow. When the price drops, it's often just the market having an emotional breakdown, not a change in the company's ability to generate value. This is a highly calculated game. We aren't guessing. We are positioning ourselves in assets that the world needs to function. To survive the volatility test, you must move from thinking to knowing. Thinking sounds like this: I think the market will drop more, so I'll sell now and buy back later. This is theory. It's a guess. Most people who try to time the market this way find out that the market surprises them, humbles them, and eventually leaves them behind. Knowing sounds like this: I know this company is earning $1 billion a year and trading at a historical discount. I know the fundamentals haven't changed. Institutional investors don't have to be right about the future. They just have to be right about the value. If you know what you own, you can be at peace when the price is moving against you. You stop seeing a dip as a loss and start seeing it as a business expense, part of the cost of doing business as a long-term investor. Think about how Warren Buffett and the late Charlie Munger approached their greatest acquisitions at Berkshire Hathaway. When they bought a stake in Coca-Cola or fully acquired See's Candies, they weren't checking the ticker every 10 minutes to see if they were right. They looked at the business as a marriage, not a trade. Buffett famously says that if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. They don't change their minds because the Fed issued a new statement or because a headline claimed sugar was out of style. They understand that a high-quality, cash-generating business is a productive engine that compounds over decades. If the price drops 20%, they don't question their intelligence. They look at the company's balance sheet, see the cash still flowing in, and stay the course. They know that as long as the engine is running, the noise from the road doesn't matter. There is a massive cost to being active during periods of fear. The biggest profits often come during the most uncomfortable moments. If you missed just the 10 best days in the market over the last 20 years, your total return would be cut almost in half. The problem? Those 10 best days almost always happen right in the middle of a crash or a massive correction. Growth happens when you stop touching it. Imagine planting a tree and digging it up every week to see if it's growing. You'd kill the tree. Wealth is built through the quiet confidence of staying positioned when everyone else is running for the exits. There is a dangerous misconception that investing should be exciting. We live in an era of 24-hour financial news cycles and flashing green and red tickers on our phones. This creates a dopamine loop that makes you feel like if you aren't constantly trading, you're falling behind. But I want you to hear this clearly. Investing is not entertainment. If you are looking for excitement, go to a casino. If you want a rush of adrenaline, go skydiving. But when it comes to your hard-earned capital, excitement is usually just a precursor to a loss. Think back to the real estate example. If you bought a $500,000 house today, would you wake up tomorrow morning and be excited to flip it by Friday? Of course not. You bought that house because of the location and the long-term utility. In the stock market, the liquidity tricks your brain into thinking you should sell in seconds. This is the dopamine trap. When you treat a high-quality asset like a gambling chip, you've already lost the mental game. The most successful institutional investors are, quite frankly, very boring. They spend hundreds of hours researching a single company. They look at the debt-to-equity ratios and the free cash flow margins. And once they find a quality asset, they do the hardest thing in the world. They sit on their hands. Real wealth is built in the boring years. It's built in the months where the stock price goes sideways or dips slightly, while the company quietly continues to dominate its industry. If your investment strategy is giving you an adrenaline rush, you aren't investing, you're speculating. At Zenvesting Academy, we focus on calculated conviction. We aren't looking for the next big thing that might go to zero. We are looking for the companies that have built the digital and physical infrastructure of our modern world. When you own a piece of a business that the world cannot function without, the day-to-day price movements stop being exciting and start being irrelevant. The reality is that wealth is not found in the activity, it's found in the ownership. When you own quality, time is your greatest ally. When you own garbage, time is your greatest enemy. Most retail investors are constantly swapping their quality for garbage because they're chasing a chart that's moving faster. They trade away a future multi-bagger just because it's been stagnant for 3 months, only to buy into a hot sector that is currently peaking. This is the definition of insanity. You are trading a productive asset for a fleeting moment of excitement. To win, you have to embrace the silence. You have to be okay with weeks where your portfolio does absolutely nothing. In fact, those are the weeks where the real compounding is happening behind the scenes. The companies you own are out there signing new contracts, optimizing their margins, and buying back their own shares, while you're busy worrying about a headline. If the company is working, you don't have to. So, how do you practically stop that pit in your stomach? You need a mechanical system that overrides your biology. First, implement the market cycle quarantine. This is a rule where you commit to only checking your total portfolio balance once a week, ideally on a Saturday when the markets are closed. Checking your account during trading hours when the market is red is like staring at a wound and expecting it to heal faster. It doesn't help the process, it only increases the urge to pick at it. By looking at your numbers only when the noise of the live ticker is silenced, you can assess your progress with a clear head. If you find yourself reaching for your phone to check the price during a dip, stop and ask yourself, am I looking for information or am I looking for a reason to panic? If it's the latter, put the phone down. Second, the thesis validation. Look at your notes. Why did you buy this company? If the revenue is still growing and the moat is still intact, the price movement is noise. If the thesis hasn't changed, the trade shouldn't change. You should have a written reason for every single asset you own. If price went down isn't a reason to sell in your original plan, then it shouldn't be a reason to sell now. Third, Mechanical automation. Don't watch the live price. Set your limit orders at your target value zones and walk away. Institutional players don't sit and stare at tickers all day. They set their parameters and let the system execute. They have buy orders sitting at levels they've already determined are deep discounts. When the market panics, their orders fill automatically while they are out living their lives. True wealth isn't built by being a genius. It's built by being the most disciplined person in the room. The market is a machine designed to transfer wealth from the active to the patient. Stop reacting to the noise. Start trusting your calculations. Solid companies aren't going to zero, and the volatility you're feeling today is just the entry fee for the returns you'll see tomorrow. The biggest advantage you have as an individual is your sovereignty over time. You aren't being forced to produce a quarterly report or justify your positions to a board of directors. Your only responsibility is to your own long-term goals. While the systems around you are built to profit from your momentary lapses in judgment, your strength lies in simply refusing to participate in the noise. You don't have to beat the machine. You just have to stop letting it control you. By staying in your own lane and trusting your process, you protect your wealth and, more importantly, your peace of mind. Be Zen. Plan the trade, trade the plan. If this helped you find some clarity today, hit the subscribe button. We're going to keep stripping away the hype so you can grow your wealth calmly and realistically. See you in the next one.